Good morning, ladies and gentlemen. Well, the market continues with this dichotomy of a couple of weak numbers for the real economy, followed by a stronger number. It's very difficult to tell what the market ultimately wants to do, but I will now go through what I'm looking at and what I'm looking at as long-term triggers for the market having decided which direction it, or which narrative, better to say, it is buying. At the moment, it's not buying any of the narratives, as I've indicated here. It's basically saying that any of the outcomes, or the most probable outcome, is one of very mild weakness in the economy, which is more than going to be made up by lower yields. That, a few weeks ago, or even a couple of months ago, was one of the least likely outcomes, and now it seems to be one of the favored outcomes. But this narrative keeps on changing with every number, and CPI could certainly completely destroy it. It's doubtful. We haven't seen an acceleration in any of the prices which ultimately determine inflation. Even the oil shock of the past week has been very mild, and we've stayed below $84 a barrel, which I think is a very important level. So I think next week we will probably continue to meander, but it's very important to know what the yield curve decides are going to be the breaking points. We'll go through them again. They haven't changed very much, but they're there and they're very close, and the yield curve could really break at any moment, and in which case we will know how to trade all assets. Let's start off with the yield curve. And what you will notice is this pattern of the Bollinger Bands compressing in both the yield curve and the outrights. Every single tenure, basically the same picture. This tends to happen before a sustained move in one or t'other direction. We don't know which way it's going to go, but it's obvious that we haven't had a close below this 12 level for quite a long time. And certainly this zero basically level is going to be a very important swing on the downside. Because if the curve is going to disinvert, from now on it's going to go very, very fast. Or it's going to go back towards this 66 level, whatever, this kind of level, maybe try to fill these gaps. One way or the other, we shall know in the course of the next couple of weeks, because when this happens, that means that the energy is going to be released in one direction or the other. So that's 2's 30s. Much the same picture really in 2's 10s. It just won't go below this 39.40 level, close below there. If it starts closing below there, the yield curve is saying I am disinverting. Disinversion of the yield curve basically says that the Fed is very, very close to cutting. Now, why would the Fed be very close to cutting? I don't know. Something is going to break. That's what the yield curve is saying, that something is breaking. 5's 30s, where is that one? Here it is. 5's 30s, same picture. Really, any close below this, and let's call it here, minus 32, and we will be in a new regime. I mean, look at this whole period that we are going to be leaving behind. We are talking about a year's worth of trading at deeply negative levels that's going to be left behind. That tells you that the shorter end is disinverting fast, falling below the 30s, and that is going to be quite some move on the downside. If it doesn't happen, if CPI is high, we're going back here. We're going to zero, basically, at least. And then we will see which way we go from there, probably go and try and fill that gap. What will that say? That will say that the whole of the banking episode is being taken out. The economy has not suffered in the slightest from the banking crisis. Is that high odds? Well, it doesn't seem to be high odds to me, but that is what the yield curve will be saying. We have the levels, we know what to do. It's really as simple as that, because the yield curve will not give us a bum signal. I'm absolutely sure of that. Let's do a quick run through every single maturity. And basically the 1 month is stuck just below the RRP rate. The 3 months is basically stuck just above it. I think 1s and 3s are not going anywhere at all, because the demand for short-term paper from the money market funds is just too great. You have the 1 year basically going nowhere. And then the interesting stuff. 2s, well, this level is absolutely pivotal. Any close below 370, let's call it, gives us a trend in the 2 year. Why would the 2 year trend below 370 and go towards these levels, 287? Well, it can only be because the Fed is going to imminently cut rates, or the bond market is calling for imminent cuts in bond by the Fed. Can I see why that would be? No, because I think inflation is going to remain sticky. So my favorite direction of travel is actually towards this 426 level at CPI. We have 3s, 10s and 30s next week. 3s before CPI, 10s on CPI date, 30s after CPI. So if CPI is as expected or worse than expected, I certainly think the direction of travel for everything is going to be towards this resistance, and that is why I'm actually remaining short of 5s. So I'm looking in 2s for around this 424. In 5s, I'm looking for this area again between 370 and 362. And I think 5s will definitely suffer on Monday and Tuesday as people set up for the 3s auction. In 10s, well, it's a very, very clear chart. We start closing below 324 and something big has changed. I have no idea what. My favorite direction of travel is towards 362, 369. But in 20s, we also have a very clear level. 365. And this is where the T-bond contract is going to come in very useful, because if we start breaking through there, I have to be a long-term buyer. And in the 30s, the picture is nearly as clear. We start closing below these levels, and we are definitely testing these levels around 345. And we break 345, we are going a long way down, basically all the way to 296. It's not complicated. And really TLT, this chart of TLT gives you, makes it even clearer. We are not here because on Friday this was closed. We are going to open around 106, 106.50, and hopefully go down towards 105. But any close above this 108.50 area gives us 112 almost immediately, and probably even 114. So it's all very, very clear. All this area will be taken out and we will go to 114. I'm not saying that's going to be happening. It depends on CPI. but the charts are very clear what the consequences are of breaking those levels. Why it would happen, I have no idea. And how that would allow, with the longer end going up in price, how that would allow the yield curve to disinvert, I have no idea. But the market does funny things and you have to listen to what it's saying. Any kind of disinversion of the yield curve will give you immediate calls for cuts by the Fed, and that can only come because something disastrous has happened. What it is, who knows, but we have our levels, we know what we're looking at. Now, one reason why I don't believe that the US yield curve will disinvert, certainly not next week, is because the situation in the German yield curve is nowhere near as alarming as in the US curve. And therefore it's telling me that the odds that the US will do it are lower than the market seems to expect the possibility thereof. This is 2's 10s in Germany. And as you can see, it's nowhere near, if you compare this situation to the charts of the US yield curve, it's nowhere near as dramatic. And don't forget, this market was closed on Friday, so we're probably going to open somewhere around here. So this yield curve is actually still traveling in the direction of, more inversion. 2's 30s, we will probably open somewhere around here, so we are taking out this break below this kind of level. And it's just not anywhere near as dramatic. If we look at 5's 30s, we will probably be up here. So we are, it's just not as a dramatic a situation. We will just have moved something like 30 basis points in 5's 30s in Germany, as opposed to quite a bit more in the US and threatening disinversion. Here we're just nowhere, we're going to be nowhere near as dramatic as it was as the situation is in the US. So to me, the situation in Germany is one of relative calm. If we now have a look at the 2's, we will probably open around 268 again. And that basically is telling me that there is really not going to be that much pressure to do anything in Germany over the course of the first few days. 5's, much the same. The direction of travel on Monday is going to be this one, around the 230 level. And we have the resistance and we have our supports. Basically, if we start breaking below this kind of level, 201, and closing below there, we will be going towards 160, and that will be a confirmation of the direction of travel of the US. But I think those are lower odds at the moment, and I just don't think that it's that likely. If we look at the Bund, really any close below 199 is indicative that we will trade 178 very quickly. But otherwise, the situation here indicates to me that that Germany is behind the US and it will be reacting to the US rather than leading it. So, and why would that be? Because if we have a look at cross US to Germany and we have a look at the 10s, this move didn't happen because actually Friday Germany was closed. So, we could be here, but we're certainly not there. But we're getting very close to this 105 level that I think is going to be the bottom for quite some time in the relationship between Germany and the US. And therefore, it's much more likely that the US leads. This was a period that the German rates led over US rates. And now I think we are probably for a period of trading between 105 and 135, which basically means that the bulk of the downward pressure is going to be in the US as opposed to the German curve, and that to me means that Germany is going to move a lot less than the US. So we're looking for the US to lead us now as opposed to Germany. Just one more word about the 5-year and to give you some very precise levels. As you know, I'm short, I'm still short. I'm short from bad levels, but I'm now back almost at break even. In fact, through break even with what I did on the fives, buying half the position back. What are the levels that I'm looking in fives? And the fives to me are going to be the most important here because the belly has to react the most in this situation. I think that I'm hoping to see 361 or 362 before CPI, and then I will be out because the risk reward actually is not that great. I know that CPI one way or the other will resolve the situation for the next few days, and I think it's far more likely, or the probabilities are higher, that it resolves it to the upside, because I really can't see what will have brought down inflation that much over the course of the past month. Did we have any particularly good news? No. Did the oil price do anything extraordinary? No. Did the commodities do anything extraordinary? No. And therefore, I really don't see why we should have any kind of a big surprise in the CPI figure for this month. We already know that the oil price is, 5% higher for next month, but that is going to be reflected in the next month's CPI figures. So the market, even if this month's CPI is slightly better, and I see no reason why it should be, it should really discount it because it knows that something worse is coming. But really this area here in fives between 361 and 371 is absolutely pivotal, because the next move is either back up towards 406 or it's through these levels at 328, and that gives us very quickly 307 and possibly very quickly after that 268. It's just going to be a cascade because the belly will react most and the yield curve will adjust most in the belly. So I either have the best position or the worst, in which case I think around 362, I think really you are supposed to get out and react after the CPI. The final thing that I will be watching like a hawk next week is actually 10s, 30s. As you know, made a whole load of money here in the 10s, 30s, riding it down. And 10s, 30s is one of those spreads that really should never go negative. So if we are at minus 15 or something like that, and it can't go any higher than that, and I'll give it a couple of days to see how it behaves, I think the risk reward then changes to down. And really you are only looking at a 10-15 basis point risk for possibly a much greater reward. I don't know what's going to give you the much greater reward, but the risk reward of having that position on for a few months is probably great. And let's change it to a monthly chart so you can see. I think the maximum risk is towards 0 from now on, and that it will definitely, it might behave just like this, many months trading, around this kind of level, -6, -7, with the top side and the downside around -15, that kind of thing, and then eventually it breaks, because when it breaks, it goes fast, and it always goes to around the -75 area. So for very long-term players, you are looking at, 15, 20 basis points of risk. You're not looking at big negative funding because 6 basis points or 7 basis points over the course of a year is nothing really. You're looking to leave it on for probably something like a year, and this is where you're looking to cover it around the 70 area. So to me, this is a good risk reward. And really, if you are running a long-term portfolio, I would, at those levels, I would be switching from the 30s duration to the 10s duration and see what happens. I think it's going to be a profitable trade, whatever happens over the course of, let's say, the next 12 months. The dollar is actually doing very much as I thought it would. And if you look at this chart, it gives you a risk reward for actually higher DXY. The Bollinger Bands are compressing on the weeklies and on the dailies, much like they are on the US yield curve and the individual tenures of the yield curve. That to me, having looked at also that the US rates are going to be the leaders as opposed to the German rates, as I showed you a little bit earlier, would imply to me that CPI is actually going to be sticky or on the high side or as expected, and that US rates are going to go up a little bit while German rates do not a lot, and that reacts the dollar towards this 103 level. But as you can see, to me, it's stuck. It's stuck between, if you look in Euro USD terms, it seems to be stuck between this one, just around 110 area and this 107 to 105 area. All the meantime, the 200-day moving average is turning, telling me that the likelihood that we are going to have a sustained move in the 105s or 104s is very, very unlikely. And therefore, it's by the dip time towards those levels. How can we put all that together? CPI is sticky, US rates rise, the yield curve actually flattens, i.e. goes more negative. The differential between US and Germany from that 105 area in the 10s goes up towards 130, 140, brings the US dollar down towards this 105, 107. We don't break, something breaks in the US, then the yield curve breaks, then we get higher dollar prices, but it takes time. So in the meantime, I think the dollar is stuck between this 1010 and 105 area, probably with a tendency to come down towards this 106 area over the course of the next couple of weeks, and then we could have a bigger bounce. That is how I'm putting it all together at the moment. Well, gold touch perfectly 2045 and backed off. This chart and the dollar chart and the yield charts all are basically saying the same thing, that the likelihood of it coming back to 1959 is higher than the likelihood of breaking 2045. And same pattern of the Bollinger Bands constricting. You can see how we didn't go higher than the weekly Bollinger Band. Everything tells me the likelihood is that we come back towards this 1950 area of support. And again, what would that say? Much the same as I've just told you in the US dollar. It's all pointing towards a little bit higher dollar, a little bit higher yields, and no disinversion of the curve next week, which basically says that CPI is as expected or slightly higher than expected, and the market basically takes away any illusions it might have that the Fed is going to cut anytime soon and nothing breaks. So it's all pointing in the same direction. If you look at DBC, actually, if you're long of DBC, you must be very disappointed. I mean, OPEC comes out and does what it did, and what's the response? We can't even close above 24.39. Basically, it's a doji. We spent all week going nowhere. That to me is not particularly bullish. Same pattern of the Bollinger Bands constricting on a weekly, which says probably that we have many weeks of hesitation here, which it, again, ties in with everything else. Weeks of hesitation while the market decides whether we are going to have a weaker economy or not, whether the yield curve is going to disinvert or not. Probably many false signals in between. To me, the fact that we couldn't even break 24.39 is significant, and I think lower oil, and the fact that we just can't break 84 on oil. I wish I could show you oil, but my chart is not updating. There's something wrong with them. As you can see, I can't get weekly, I can't get daily data, but I know where it is. Basically, it's saying if it's below 84 on oil, it's still bearish. This to me is still a bearish chart, and this oil over gold is beginning to say, we'll spend weeks going sideways, but eventually we bust through and we go higher. So that is saying eventually we get recession, because the only way that gold can go up and oil go down, for this to go very hard that way, can only be because we get some kind of a mild recession and the demand for oil falls, as opposed to, and the Fed cuts rates and gold, everybody buys gold. So what would this chart be saying? And it's worth talking about, because this chart, if it starts busting through these levels and going to here, say in the 9s or, very close to 10, to me that can only say that the Fed is prioritizing a weak economy over inflation, over its fight against inflation, and that the oil price is stable to going down, but gold is reacting higher as a result. It's not going to happen for weeks, I don't think. I think it's much more likely to do something like here and basically just go sideways for a while and let this moving average catch up to the upside. But then it just, to me, this chart is saying keep on preferring gold to oil for the foreseeable future. And if it really can't fall below here on any kind of a retracement, to me this is a bullish chart in the long term and says that you have to like gold. Moving on to equities, well, they're not saying very much, but the fact that they will not go down, and have a look, this is the 195-minute chart. Look how perfectly it is trading technically. It can't break the 40.68, 40.69 area, and it just can't break the 41.29. It's just going sideways at the higher levels. It's basically saying that it's not bearish. Let's face it, this is not a bearish chart at the moment. We really need to have closes below 40.68 to have any thoughts that this might be a bearish chart, and then it goes to support at 39.74. And really, I think the likelihood of breaking that level is minute at the moment. So what is all this saying? How can bonds be looking for one thing, i.e. lower rates, curve disinversion, whatever they've been looking for the past couple of weeks, and the stock market not reacting to the downside. If you just looked at the bond market charts, you'd expect stocks to be quite a bit lower than they are at the moment. And apart from the narrative that we are all buying NASDAQ because of AI, which, is that a valid argument? Yes, it has some validity. Some percentage of the reason is in that. Whether it's very high or very low, I don't know, but some percentage for sure. What this chart is saying is that the likelihood, or the relationship between all these charts is saying, is that the likelihood of a deep recession in the US, the market just doesn't agree with it. It agrees with some recession, but it's saying that the indices themselves are not going to go very far. It's saying that the volatility is going to remain quite low, and that the only things which will be moving are actually the sectors between each other as opposed to the indices themselves, i.e. the indices will be dampened by one sector going up and the other one going down. So it's a question of probably trading sectors if you want to be quite leveraged in your views, as opposed to trading the indices themselves. What we can do is we can have a look at daily charts and see if those give us any clue. Let's enlarge the daily chart. And really, it's very, very hard to say that this is a bearish chart. It basically comes down to support, can't close below support, allows time to go by, does a flag, and really it's saying that the next level that it's going to go to is going to be these levels here around 41.50, rather than come down and trade below 4,000. I think that's quite unlikely. I think the upside is more open than the downside. That would suggest that really rates are not going to move very far to the upside or to the downside. I think what all these charts are saying is that the yield curve is going to remain roughly where it is, i.e. still negative, i.e. negatively sloping. The Fed is not going to cut anytime soon. We will go from bouts of euphoria, the Fed needs to cut, to bouts of, the Fed won't cut for weeks and months, etc., etc. And in the meantime, the US economy, if it does slow, it will be saying that the downturn is going to be very, very mild and restricted to certain sectors. That's the best that I can come up with as to why these charts look the way they do. So in that case, if NASDAQ is still key, let's have a look at NASDAQ. It's just not bearish, is it? I think it's far more likely that we will trade 13,312 at some stage and fill, these gaps all the way up to this 13.5, 13.6, than we are to break below 12,430. The fact that on a retracement, as you can see here, on retracements, it doesn't even touch support, but it's, held up above support, and here as well. This tells me that there are, a lot of buys on dips. In which case, you certainly don't want to be short this contract, and you want to trade it long towards this 13,312. Do I think it's going to be a million miles away from there, in the next week or so? No, I don't think it's going to be much higher, and I don't think it's going to be much lower. It just shows you that it's supported and that the, direction of least resistance is going to be towards 13,500, but the volatility is going to remain relatively low, certainly close to close. And speaking of vol, I mean, the lowest close we've had, this year has been around the 1780 level, and we are fast approaching it. The fact that any and all, spikes in vol are basically contained by 2270, and we can't close above 2270, indicates to me that we are in a low volatility regime and not to expect the stock markets to go down very much. I think any retracement, is technical and is limited to the 1.5%, 2%, whatever is enough to stop people out of their position, and then it very quickly reverts. So really there is nothing in the volatility charts which even warns you that we might be close to a bottom. I think it's far more likely to keep on trading between 20 and 17, giving you a mild uptrend still in prices, or certainly a buy the dip scenario. Nothing seems to have changed. And that is, exactly the same if you look at all the different markets, whether it's the UK or the German market. I mean, this is really not a market which is bearish. We are exactly where we were, a month ago before this banking crisis and so on. And basically these charts, all the foreign charts, whether it be Germany, whether it be stocks, they're all very close to the highs, and the retracements are very mild. Every single chart, including the Nikkei, is saying you want to buy the dip, and every time you buy the dip, you are rewarded. You don't chase, but you buy the dip. And even the EEM chart is saying the same thing. It won't close below 37.64. Therefore, it's more likely to break 39.93 to the upside, and at some stage test where we were back in January, February, around this 42.25 area, which is very, very pivotal. I don't think we break that for a long time. So I think all of these equity charts are basically saying the same thing. The downside is contained. The upside is also to be favored, but it will be contained. There isn't a single risk chart that I'm seeing which is basically saying that we are anywhere near an important risk level that the equities are going to break. And I'm very quickly going to show you some of these risk charts. SPY over TLT, as you can see, very much in the middle of everything. Nothing is happening here. RCD over RHS, which is equal weight, defensive against consumer durables. This is probably the most bearish one that says there's most risk, but it really is in a range, and it's contained. It's not saying we're in a risk on area or a risk off. It's been trending down since February, but it's stabilized. It's certainly not doing any worse than it was during the banking crisis, and this is what it looks like when it's in risk off. Could it be the start of a risk off? Yeah, but it's the only one that's saying that we are anywhere bad, or even slightly bad. I thought over iGov, well, if we were going to have something bad happen, we will be testing the 365, and we are nowhere near it. We're right in the middle of a huge trading range for the whole of 2022 and whole of 2023. So it's really giving you no indication. there isn't a single chart of risk that is saying that anything is imminent or anything is looking bad. We have bank earnings next week. We start the earnings season with them. And, it's too early to expect the banks to have a nightmare earnings, because it's really the episode with the banks started certainly with the major banks shouldn't be affected by it as much as the regionals. The regionals will have bad earnings, but that is more than discounted by the price of KRE. So I'm not telling you anything that is outrageous here, or the market doesn't expect. But what I'm saying to you is that since the yield curve is actually the most unfavorable it has been for a long, long, long time for bank earnings, any rally in XLF, I think, is an opportunity. Say JP Morgan comes out with decent earnings, and say then Goldman Sachs and Morgan Stanley and whoever, Citibank, Bank of America, that is not a reason to buy XLF. Okay, please don't buy XLF. It's a reason to buy long-term put spreads in XLF, because if we get a 5-6% rally in XLF, that will be my signal to actually buy puts in XLF, because these jaws will close and you will get a move to new lows in XLF. I'm absolutely sure, if the yield curve stays down here. So either we will make a lot of money in XLF, or we'll make a lot of money on the yield curve, one or the other. But this relationship is not going to remain like this, because this forecasts awful earnings for banks for the next quarter. And with that, onto the biases. I'm short fives, and I will remain short fives until I see a reason not to be, and I think the reason will be that we are at 362. From there on, I still think the more likely direction of travel is towards 371 and 382, as the negativity of the carry bites and people just give up, because I don't think that these yield levels are justified given what we are seeing in the economy. But I seem to be wrong. In any case, these levels are the important levels. I don't think we go through the upside of them, but it certainly would be a huge signal if we went through the downside of them. The yield curve, I told you what I think. I don't think it moves next week, but we have our levels. We know which levels are important, and closes below them will be very, very indicative that the market has made up its mind which way it wants to take all asset prices. I don't believe it's going to be next week, but let's wait and see. That's why levels are important. In any case, have a wonderful Easter, and I will tweet you tomorrow.